Thanks for joining us today on Market Call. I'm Morella Fernandez. We have Ernest Wong on the show, head of research at Baskin Wealth Management. He'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266. You can send your questions in as well. Market Call at BNNBloomberg.ca. Thanks for coming in. Good to see you.
Good to see you.
What's your take on the robust markets despite a conflict that hasn't been resolved?
Yeah, so most companies at this stage have reported Q1 earnings. And for the most part, earnings have been quite resilient, actually, despite the situation in the Middle East. I think from a stock market perspective, in the U.S., most of the recovery has clearly gone to kind of what I would call AI-adjacent companies. So companies that are providing the supply chain and parts for data centers that power AI. A lot of the consumer and the industrial economy remains fairly sluggish, especially for the low-end consumer, where one way I like to look at it is that DoorDash is doing great, but McDonald's has to cut prices and still isn't really seeing demand.
Okay, so let's talk a little bit more about the fact that the last half of last year, investors were worried about Capex spend being too much and nothing to show for it. Do you think those concerns have now passed?
Yeah, so it does seem like at this stage, the market is expecting that the big techs are going to continue to spend on AI, regardless of what returns they're earning on this capital. And that's what is powering the strong performance of these companies that are supplying the data centers, while the big techs themselves, the share prices themselves have not really been going up as much.
We also have KUSMA getting reviewed towards the middle of the year. I'm wondering how you see that playing out on the markets. We remember, of course, April of last year, where tariffs were announced and the up and down craziness of that time.
Yeah, so the Canadian stock market is much more commodity driven. And I think given what's happening in the Middle East, investors have largely forgotten about the upcoming renegotiation of KUSMA, even though that is going to be a much more consequential event for Canadian equities and the Canadian economy overall. Overall, I would expect that there's going to be quite a bit of volatility from Twitter or
Truth Social.
Truth Social,
yes.
Or as the various entities involved position themselves for the renegotiation. Ultimately, we do think that there will be a successful renegotiation, given both countries do need what each other is offering.
Do you think it'll still be a three-party agreement, or do you think it'll move to bilateral agreements? What are you betting on?
Yeah, so I think that the areas of focus for the United States is quite different for Canada and Mexico. For Canada, it's going to be around natural resources that the United States might want more secure supply of, especially in the wake of what's going on in the Middle East, for things such as sulfur, for things like rare earths, for even oil. Whereas on the Mexican side, it's going to be more focused around auto jobs and onshoring and those kinds of things. So I do expect the details to differ quite substantially between Canada and Mexico.
But you still think it'll be a three-part agreement,
yes,
as opposed to separate deals?
Yes.
Okay. Let's leave it there. We'll line up some phone calls and some emails for Ernest Wong. He's taking your questions today on North American large caps. Here again is how to reach us, both the phone number and the email address. Market Call at BNNBloomberg.ca. We're back in a moment. Stay tuned. Welcome back. We are going to start with an email from Tom, who says, would he please comment on Capital Power, he being Ernest Wong, who's with us today as our guest. Some of the brokers have a target of $80, much higher than the current price. What does he think? I was looking up analysts on our terminal. They have a target price of $74.60, but definitely a strong buy from a lot of the analysts here. What do you think of Capital Power?
Yeah, so Capital Power is a utility company that focuses much more on the merchant electricity side, which means that they are selling electricity into the open market. They don't usually have contracts for the power that they're selling. I think usually when I think about utilities, I'm thinking about safe dividend-paying companies that have fully contracted revenues, are well-run, and have kind of predictable, long-lived cash flows.
No surprises.
Exactly. Capital Power certainly has upside if there is electricity shortages, but not really something that I personally would be looking for as a dividend type name.
Also, would you expect that kind of growth for the stock, considering it's at $67.10? He said some of the analysts were looking at it at $80.
Right, and so I think if you expect that there's going to be a shortage of electricity because of things such as data centers or that are consuming way more electricity than is currently being produced, then I think you would certainly be able to capture some of the upside from something like Capital Power.
Okay, let's go to the first phone call then. Taraver's on the line. He is in Sierra Vista, Arizona. Taraver, go ahead.
Thank you. My question is on Adobe, which I think a lot of people have. You guys have been positive on it for, I think, 8 years, even until last November. And then in January, you sold off. What changed with Adobe, this high performer, high growth? Can you please explain? Thank you.
Okay, thank you for the question. Was it just concerns about software?
Yeah, so Adobe has clearly sold off together with the rest of the software industry over worries about AI disrupting the demand for things like Creative Cloud and Photoshop. Yeah, we had previously owned Adobe, but we sold the stock because of two things. Number one was that in this current environment, a lot of the market is really not discriminating between quality, and we thought we could redeploy the money into better ideas. Mm-hmm. And then secondly, there has been a CEO change as well, which is something that we don't really like to see when there is a big debate about the future of the company. Overall, it still remains a very strong and profitable business, but one that we no longer hold.
Okay. Taraver, I hope that was good for you. Let's go to Bob in Toronto with a question. Bob, go ahead.
Hi, Mirella. Hi, Ernest. Thanks for taking my call. Ernest, your thoughts on Element Fleet Management? I had a high of 40, now it's 28, and I know the last week it's really been tanking. So I'm wondering what the reason was, and if you hold it, do you hold it, and what's your prognosis for the stock? Thank you.
Thank you for the question. Any obvious reason for a decline for Element Fleet?
Yeah, so again, it's related to worries about software, because what Element Fleet does is that they do a lot of fleet management software and financing for some of the fleets that exist. We don't really follow it super closely, but it's one that has done a great job of turning around the business from some of the issues that they've had in their portfolio in the late 2010s. What I would look for is clues that they are continuing to win contracts in the Element Fleet space, that they're adding on AI solutions to their customers, and that would be what I would be looking for.
Okay, so if they're doing that, there's chance of recovery here.
And I think that's true in general for software adjacent type businesses, which is to look at the stickiness of their solution and their ability to upsell and transform their own operations with AI.
Do you think that investors are discounting that some of these businesses are going to use AI for their betterment of their own bottom line, as opposed to having their business being eaten by AI?
I think there's both, right? So certainly with the last question with Adobe, they are, on the one hand, they are creating AI-powered solutions that can be used within Photoshop, such as Photoshop Generative Fill, whereas as well as using AI to improve their margins. So doing things a little bit quicker, having maybe slightly less coders than they previously needed.
Okay, let's go to our next caller. Dennis is on the line. He's in Prince Albert, Saskatchewan. Dennis, go ahead.
Yeah, good morning or afternoon. Thank you for taking my call. Could you please help me understand the new IPO proposal by Barrick and what effect it will have on the existing share price?
Okay, thank you for the question. So Barrick's going to spin off, I guess, its North American assets in an effort, I guess, to do the jurisdictions they do business in are risky outside of Canada.
Right.
So is this just an idea of isolating the business that does well and maybe propping up the other side of the business in a different way?
Yeah, I think that's exactly what the logic is, where especially with what is happening in the Middle East, there has been a bigger focus on mining jurisdictions and commodity players that are operating in safe, reliable jurisdictions that have kind of regulatory protections for the shareholders. Mm-hmm. And I think for gold companies in general, clearly obviously very correlated to gold prices, but valuations overall, if you assume certain level, assuming current gold prices, they still seem quite expensive to us. And so we're not enthusiastic buyers of gold.
Just wondering what you think of the idea of spinning off the North American assets on its own.
Yeah, so I think what you're seeing is that there is certainly to that point, there is a premium being assigned to North American mining companies that do operate high quality reserves in attractive jurisdictions. So it may provide some a bit of a bump as they complete that.
A bit of a benefit for them. Yeah. Okay, let's take a quick break. Ernest is here to take your questions on North American large caps. Here's how to reach us. Back in a moment. Welcome back. Ed has written in his question today. He says, could you give me your short-term outlook on Nutrien, say 3 to 6 months? Nutrien, of course, fertilizer, caught up in the conflict which is going on in the Middle East. Some of that fertilizer not getting through where it needs to get to. So let's have a look at Nutrien. 97.83 today. Do you have a short-term outlook for it?
A shorter term, not really. I think longer term, what we are, again, due to Nutrien's position in having fertilizers in North America, it is a safe, reliable source of fertilizer where if you compare that to what's going on in the Middle East, especially with the natural gas-based fertilizers, urea, they're not able to ship them to farmers around the world. So I do think that you're seeing that reflected in Nutrien's stock price performance over the last couple of months.
And as long as things remain relatively closed for the Strait of Hormuz, Nutrien can benefit from that.
It would be more of a shorter-term tailwind for the company, as it did in 2022 when fertilizer prices were high.
Okay, let's get to our next caller. Elliot's on the line in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Fair Isaac is down about 45% from its high. It's the big dog in the world of credit scores, and most of its competitors admit they even use the FICO scores as part of their basic algorithms. Please, your assessment of FICO, and would you start a position today? Thank you.
Thank you for the question. It has trailed off quite a bit since last year. Is this also a software concern?
No, so the concern for Fair Isaac is that a lot of the revenues that they generate are go into the securitization programs for Fannie Mae and Freddie Mac.
Yes.
Where today, under the new administration and the new leadership of the FHFA, the regulator, they are taking initiatives to introduce competition to the FICO score, so allowing an alternative score to be used for these securitizations. And so the worry is that these are going to, number one, create competition for the volumes that they sell, but more importantly, reduce the amount of pricing that they can increase going forward. Because for most of Fair Isaac's near history, they have very aggressively been raising prices. We do think that the competition issues are ultimately not going to be a material problem for FICO, and we did initiate a position.
Why is that? Why do you think they won't be a real problem?
Yeah, because if you look at the FICO score and how it's integrated into the entire ecosystem, we think it'll be very hard for both the securitization market, the lenders, and the credit rating agencies and the entire value chain to migrate to a new score. At the end of the day, most of the price of the credit score is borne by the consumer, and it's a fairly immaterial amount relative to the entire cost of closing a home.
Interesting. Okay. Let's get to Gord in Camrose, Alberta. Gord, go ahead.
Hi, good day. My question's on TransAlta. I guess it's a bit of a follow-up to the Capital Power, but more wondering just kind of why it's been so disappointing of late and why you don't see more mergers within the utility section, being that they're kind of a rate-controlled business and the growth is somewhat limited. I was just wondering if there's any
Thank you for the question.
Mergers.
Okay. Thanks for that. Do you have a reason that we don't see sort of mergers in utilities? How rare are they?
No, I don't really think that. I think the reason you don't see more mergers in the utility space is just because it's pretty hard for a new acquirer to come in and really improve returns. Again, because these are the rates are set by the regulator. So oftentimes
there's no room to move.
Exactly. Oftentimes, what most utilities is a superior return. It's a superior use of capital to just invest in their existing infrastructure and try to generate increased earnings and dividends that way instead.
Okay, so it doesn't really make a lot of sense for a merger in the space.
Yes, and I think over the last couple of years, there have been kind of serial acquirers of utilities, and that has not ended well.
When you look at TransAlta, as you see the stock down, is there any particular reason for that?
No, I think it's just a shift away from market. The market is just not liking defensive names today. You can see this across the utility space. You see this across the consumer staples. And that's one of the effects when you have ETFs that are such a large dominant part of the market today, where they are forced to buy AI names when they are high. And that effect is placing a dampening effect on some sectors of the market.
Let's move on to Henry in Toronto with this question. Henry, go ahead.
Thanks for taking my call. I'm calling about JPMorgan. I'm a retirement age, and I'm looking for a nice, safe stock to put my money in for 10 years. What do you think of JPMorgan?
Okay, thank you for the question. I'm pretty sure you're going to say you can't go wrong.
No, exactly. You can't go wrong with JPMorgan. I think what JPMorgan has done really, really well is positioning themselves as a safe, defensive provider of as a bank, where they're attracting low-cost deposits, similar to what the best Canadian banks here are doing as well. They've done a great job of building up their wealth management practice. They have, and you see that reflected in their net interest margins, which have been great and continue to go up over time. And it's one where, if you want exposure to the U.S. banks, I think you can't go wrong.
2% yield. So if you're going to look at, would you look at that as a dividend play? I mean, it's a low yield, but it's there.
No, I think it's certainly not a dividend play compared to the Canadian banks. One other thing I would add for the U.S. banks is that under the current Trump administration, there's been a lot of chatter about perhaps reducing capital requirements for the systematically important banks as well. So that is another upside to returns on equity for a company like JPMorgan.
Let's move on then to Chad, who is in Saskatoon. Chad, go ahead.
Good morning, Morale and Ernest. Ernest, what are your thoughts on WSP Global? I know it's a little different than Aecon Group, but they're still in the same broader infrastructure sector. And let's have WSP around 315. I was just wondering why it's lagging. I'll hang up and listen. Thank you.
Thank you for the question. Thoughts on WSP?
Yeah, so WSP Global is an engineering firm that has focused more on doing an acquisition program. I think that if you look at engineering firms today, what investors want to see is exposure to, I think, infrastructure projects and exposure to the things like data centers, right?
Yep.
And so I'm not really sure, again, why the stock has fallen so much this year, but they have historically been disciplined acquirers and good integrators of companies, and I don't see why that shouldn't continue.
All right, let's take a quick break then. We will get to past picks from Ernest Wong when we come back. Stay tuned. Time now for some past picks. We will go to February 24th, 2026 for the picks from Ernest. Netflix is where we begin. 78.04 US at the time to 87.03 today, 11% upside. Total return is the same. Warner Brothers, of course, they bowed out of that bid, which seemed to do the company well. But do you see it climbing anymore? I think a lot of investors thought it would shoot back up to where it was, and it clearly hasn't.
Yeah, so Netflix did pop up right after they dropped out of the bid for Warner Brothers, and then it fell right back down, not quite back to where it was before, but fell after they announced Q1 earnings, where the outlook was a little bit softer than they had expected. We view Netflix as still a secular winner in streaming, where they have the best scale, they have the most subscribers, and they have the most money to spend on content, which they're doing in things like sports. They're doing in things like more live content. They're doing in podcasts. They're doing in video games. So they have a lot of levers to continue to improve revenues and profits going forward.
Okay, so how about the growth as regional growth goes? Are there a lot more markets that are open to them, that they have some expansion opportunity?
Yeah, so I think in the U.S. market and the North American markets are a little bit more mature. There, the play is really more around retaining existing subscribers from adding new content, again, such as the NFL,
to their platform,
select
yes.
NFL games. I think in emerging markets, such as, well, not even emerging markets, but international markets, these are places that historically have not had very much cable TV, where most of their competition is free broadcast TV. So these are markets where Netflix is going in. They're creating local content, they're growing subscribers, and creating a global content platform.
A little more work for them when they get there.
So we think that the shares are still very attractive today.
Let's get to your next past pick. Domino's Pizza on the New York Stock Exchange at the time in February was $414.20 US, down to $321.86, a 22% downside for return and total return. What has happened? Is this a sign of the consumer who's not eating out as much or not spending as much on fast food?
I think it's both. So the stock really fell after they reported earnings because same-store sales were worse than expected. And part of it is certainly the weak low-end consumer who is just more strapped for their dollars. But part of the misunderstanding about the stock, about Domino's in general, is that they are purposefully increasing promotions in a way that is very unprofitable for their competitors to match. So if you compare Domino's performance to Papa John's and Pizza Hut, both of those chains are really, really struggling, like -4%, -6% same-store sales. And they're closing stores at a pretty rapid pace. So we think that Domino's is playing the long game here, and we think that they are well-positioned to continue to gain market share.
So you would put new money in today?
Yes.
Okay. Let's go to your last past pick from February, Live Nation, LYV in New York at $157.98 to $161.30, so 2% upside for return and total return. They had a case in the U.S. that went against them, right?
No, so they had a settlement with the Department of Justice for their antitrust lawsuit. Some of the states opted not to join in with the settlement, and so they are proceeding with their own case.
Yes.
Ultimately, we do expect that this will resolve. They have reserved money aside to pay out these claims, and they have mostly emerged from all their regulatory issues with their business model intact. So,
are you concerned about the state's legal case?
No, not really. Again, they've already reserved money to pay out these claims. I think more importantly is that Live Nation is increasingly a global firm. I think this year more than half of their attendance is going to come outside of the US. And they are increasingly owning the venues themselves. So controlling the venues and vertically integrating across the ticketing and the promotion as well. So these are all things that are helping to insulate the business going forward.
Let's take a quick break, then we'll get back to your phone calls. We have Ernest Wong taking your questions on North American large cap. Back in a moment. Welcome back. We're going to go to an email from Ian. Meta said recent quarterly report was positive, but the stock still pulled back on concerns about AI spending. Would you be adding at these levels for a long-term hold? Also wanted to add to that, has there been clarity about how this company is using AI? Is it just sort of pushing it out on the social media platform to pop up interesting stories? I feel like they don't really have a lot of clarity on AI for now.
Right, and I think that's exactly why the stock slipped, even though the financial results themselves were excellent, right? Where Facebook is going to be spending $125 billion this year at the low end of their guidance on data centers and Capex. Mark Zuckerberg has been a little bit vague about where exactly he's seeing returns for this money that he's spending. But if you look at the financial results, Meta sales were up, I think, 30% last quarter, and really clearly benefiting from AI. So using AI to improve their content recommendations, using AI to improve the algorithms that are targeting ads, so improving the effectiveness of the ads, using it to generate video so that people are spending more time on the platform. So a lot of good things that Meta is doing for their business with AI, and seeing very strong returns on the amount that they're spending.
So do you think people are just looking or worried about the CapEx spend in their case? It feels like they're playing catch up to everyone else.
No, so Meta, I think the important thing to remember about Meta is that unlike Amazon and Google and Microsoft, they are keeping all of their computing for themselves. They don't have an external cloud business where they're selling compute to third parties. And that remains one avenue for them to pursue in the future if they do end up with too much computing.
All right, let's go to our next caller then. Bill's on the line. He is in Bowmanville, Ontario. Bill, go ahead.
Thank you for taking my call. I'd like your just thoughts on Vertiv. I own it. I've done very well on it. What does he think of it? Would he add to it, or is he nervous about it?
Thank you for the question. So Vertiv acts as a holding company. And what kind of operation do they have under their assets?
So Vertiv is really benefiting from the AI build-out because they are a provider of cooling, liquid cooling solutions for data centers. And I think that's part of the general theme that we're seeing in the markets today, where companies that are providing parts and services to build data centers are outperforming the data centers themselves, which suggests that the market thinks that the returns from AI are not necessarily, are a little bit fuzzy for now, but the hyperscalers, the big tech companies, are going to continue to build them. We are not super enthusiastic about many of these AI adjacent companies, because if you really look at the technology that goes in, these are not super technologically sophisticated things that nobody else can do. There's other companies that can provide similar solutions, and especially given that in the end there's only about 4 or 5 customers, which are very sophisticated and have the scale to push prices down. So one that we're not super interested in adding at current levels.
Let's go back to the phone lines then. We have Ron on the line in Coburg, Ontario. Ron, go ahead.
Good afternoon. Thank you both for taking my call. I would appreciate Mr. Wong's thoughts on Lennar Homes on New York.
Thank you for the question. Construction sells the family home, detached homes. Housing just not really taking off anywhere right now.
No, so in the U.S., the challenge with the home building industry is that interest rates remain still quite high, where people are just not able to afford new homes. What has been interesting about the home building industry is that they have increasingly been shifting to an asset-light model, where they make use of things like land options to reduce the risk of losing money and paying a lot for land and not being able to sell those houses later. So that has been a general shift. One other thing that has benefited the home builders over the last little while is consolidation, where in many major cities today, now there may be only 2 or 3 home builders, whereas before there may have been 10 or 11. So certainly a lot more concentrated, a lot more ability to maintain cost. And so I think the entire sector is, in essence, a bet on when interest rates will fall.
So if you held it on that slide down, would you continue to hold, or would you get rid of it and make your money work somewhere else?
So we don't own any home builders, but one data point that we like is that new homes today are often cheaper than existing homes in many places, which supports new home construction rather than existing housing sales. And so that's only happened very few times in the past. So one that we don't own, but would continue to take a look at.
All right, let's go to Jack in Montebello, Quebec. Jack, go ahead.
Thank you for taking my call. I'm wondering about Cogeco. Its metrics are considerably better than the other telecoms like Bell and TELUS, and the analysts have target prices in the $75-80 range, but it seems stuck in the sort of mid-60s. I'm wondering, are we going to see a breakout soon?
Thank you for the question. Do you own any of the telecommunications?
So we don't own any telecommunications. I think the entire industry, not Cogeco, but the big three have been faced with weak, kind of intense wireless competition, especially as after Rogers bought Shaw and allowing Freedom to be a more meaningful competitor. I think the issue for companies like for Cogeco specifically is more around their cable division and their fiber division, which they have a major footprint in the US. That is a very competitive space. Most cable providers in the US are not doing very well as well, partly because of competition from overbuilding as well as potential competition from things like Starlink down the road. So the Canadian telecommunications space is not one that we're interested in. We think that there's a lot of competition. In many cases, not Cogeco specifically, but in many cases, the dividends are still too high, so there's not a lot of excess cash flow to reinvest. The regulatory environment doesn't seem to be getting any better, and so we think there is better places to look.
Let's take a quick break then. We'll come back with more of your questions for Ernest Wong. He's taking your questions on North American large caps. Back in a moment. Stay tuned. Welcome back. Sharon is on the line. She is in Ontario and has a question. Sharon, go ahead.
Hi. Thanks for taking the call. I am wondering what your advice would be about ARC Resources. Would you sell now or wait until the deal with Shell closes?
Okay. Thank you for the question. Is there usually a benefit of waiting for an acquisition to go through before selling?
Yeah, so I think a lot of it will ultimately depend on the tax situation, because for the ARC deal, a decent amount is coming through, if I remember correctly, from Shell shares. So that is a more tax-efficient way of getting your proceeds. I think, obviously, you're going to be receiving shares in an entity that is quite different from what you were previously, from ARC Resources shares. So I think the listener can decide for themselves whether they think the outlook for Shell is attractive. But I think usually in these types of situations, we don't try to wait for the last extra drop of return. We just like to get our money and put it into better ideas.
So basically, the choice seems to be whether you want to hold shares in the company that's buying and whether you think that's a value to you in the longer term.
Exactly. I think maybe more specific to this question is whether I think that the deal, the little bit of spread between the deal price and the current trading price is attractive or not. And I think that usually these kinds of things are not something that we like to bet on. There are professional traders who make a living out of making these predictions. And so it would be a better idea just to move on to better ideas.
Let's go to Trevor. He's on the line in Guelph, Ontario. Trevor, go ahead.
Hi, thanks for taking my call. My question's on Thomson Reuters, ticker TRI. I bought it a couple months ago. I'm down quite a bit before, the AI narrative crushed software stocks. But the fundamentals still look pretty good. The balance sheet's really good. They're still growing revenue and earnings. Price to earnings is a little high, but they also acquired a bunch of AI technology lately through some companies. So wondering if you think the sell-off is overdone, and would you recommend I hold, sell, or even consider adding to my position?
Thank you for the question. So can I get your perspective on how you are choosing, if you are, which software stocks to now invest in, having all of them been pushed down as investors try and figure out who's going to have a business model that works moving forward? What's your criteria, and does Thomson fit it?
Yeah, so I think our general framework for looking at these types of information services companies is the difficulty of replicating their unique proprietary sources and the data that they are providing to consumers. So in the case of Thomson Reuters, they provide Westlaw, which is kind of the go-to standard for lawyers.
Yes.
And I think that in a profession such as law, that is a very critical, if companies and lawyers that are using AI resources are going to do that through a trusted provider because they want to ensure that their information is accurate.
It can't be wrong, yes.
And so for a company like Thomson Reuters, I think they're ultimately, and their last quarter's results showed that, they are going to probably benefit from being able to improve efficiency by adding AI to their software solutions.
That being said, a lot of these stocks have come off and stayed down.
Right.
So do you think investors are just wary about the whole space still, or haven't gone through the details yet to determine what is savable?
So in the case of something like Thomson Reuters, the stock was trading at a very high valuation even before the drop, I think 50 or 60 times earnings. So some of that may simply be a recalibration of investor expectations back to a much more reasonable level.
Let's go back to the phone lines. And Robert's on the line. He's in Toronto. Robert, go ahead.
Oh, hello. Thanks for taking my call. My question is on Metro. I do most of my shopping there. And I don't own the stock, but the stock has come down from $109. And in its earnings call, the company highlighted strong sales growth, but operational challenges. So do you own the stock? And if you don't, would you buy it here? It's come down from $88. Okay, thanks for taking my call.
Thank you for the question. How do you feel about Metro or this space?
So the entire supermarket space is and the grocery space is interesting in Canada because if you look at reported disclosures from Costco and Walmart, they have taken the lion's share of the industry growth from of the grocery market over the last even 10 years. So what chains like Metro and Loblaws and Empire are doing is that they are trying to target the niches that the Costco's and Walmarts cannot reach. So this includes opening discount banners, such as No Frills for Loblaws. Mm-hmm. This includes maybe providing more private label products within their stores that other stores don't have. But the fact remains that in a challenging consumer environment, it is going to be a bifurcated market where a lot of the shopping will go to discount banners. And on the high end, consumers will go to specialty stores to get what they want. So one where I think Metro still has a great position because, as the caller said, it's probably the closest supermarket to where he lives. So that's where he's going to buy most of his groceries, but probably not going to see a lot of growth from here.
Let's get to another caller. Margaret's in Cambridge, Ontario. Margaret, go ahead.
Hello. Could you please give me some information on Cameco? Does it produce uranium plus copper or just uranium? Do you own it? Okay. I heard that there's flooding there. Would that cause them to produce less for a while?
Okay. Thank you for the question. Yes, I had some flooding in Saskatchewan, I believe. Tell us a little bit more about Cameco.
And so Cameco, they are both a uranium producer. They don't produce copper, but they are increasingly vertically integrated into the nuclear facilities themselves by acquiring Westinghouse. I think that certainly uranium is a hot topic today in terms of whether nuclear power is a suitable alternative to both power the data centers as well as transition away from oil and gas. What has happened in the past, if you look at uranium, is that there has been previous supply constraints where uranium prices soared. But usually what happens in these times is that utilities sign contracts and new supply of uranium comes out from the rest of the world. And so given Cameco trades at a pretty high valuation, it's not one that we're interested in right now.
All right, let's take a quick break. We will get to new picks from Ernest when we come back. Stay tuned. Join us tomorrow on Market Call. Christine Poole will be with us on the show. President, Co-Chief Investment Officer Davis Ray. She'll take your questions on North American large caps. Let's get to some new picks. We have Stryker, SYK, in New York. as a first pick for Ernest. Tell us about Stryker. I know they make medical devices. What do you like about them?
Yeah, so Stryker's main business is in the orthopedics business, so providing artificial joints, shoulders, knees, hips, whatever.
Growing
and
business.
It's a very good business, number one, because as the joints get better, more and more people opt for surgery instead of rehab. So that's one tailwind that they have for them. Another one is that orthopedics is generally a very attractive and profitable business for the hospitals in the US to conduct. So very motivated to use Stryker's implants. And so the stock has been weak together with all of medtech in general for reasons I'm not really sure why. But Stryker is a very well-run business. They have consistently been gaining market share over their key competitors, which are Zimmer Biomet and Johnson & Johnson. And the shares have fallen a little bit because there was a hack, cybersecurity incident in Q1, which impacted their production. But a very high-quality business that should continue to grow high single digits revenue for the foreseeable future and trading at an attractive price today.
That Stryker Core, which is at 282, where I have it today. Let's get to your next pick, which is MSCI in New York, and they do sort of data providing. We talked a little bit about having that moat around it. Is that what you like about this company?
So MSCI is the main provider of international focus indices. So for example, the MSCI All World Index is something that they produce. They license this to asset managers, hedge funds, banks, and ETFs to use. And this is an extraordinarily good business where...
Very volatile, though.
Yeah, quite volatile, but it's a very good business with very high margins and strong free cash flows that is benefiting as investors are increasingly looking outside the US for exposure to those markets. So again, the shares have sold off partly because it's a data services related company, but also because of worries that active managers are increasingly facing trouble from passive investing. But this is a business that has shown a great ability to pivot in the past. They have a major presence in the ETF market that is growing quite rapidly, and shares are trading more cheaply than they have for quite a while.
Let's get to your next pick then, which is Waste Connection, WCN in Toronto. What do you like about Waste Connections? I think they are growing, right? There's more acquisition on the way for them.
So Waste Connections is one of the largest waste management companies in North America. As you said, they focus more on making acquisitions, and they specifically target smaller markets where they can earn a pricing premium, and also vertically integrated markets where they also own the landfill in addition to providing the disposal services. What we like about Waste Connections is that this is a very well-run business. They place a great emphasis on employee safety and culture in an industry where is one of the most dangerous jobs in America. So benefiting margins by focusing on making sure their employees aren't hurt.
Is there any reason the stock has dropped off the way it has? When we take a look at that chart, it's at 151, I guess. Actually, that's the U.S., but it has dropped off. Is there any pressure on the stock?
So last year, they did have an incident in one of their landfills in California where there was leaking of some chemicals and odor issues in the community. They had to end up shutting down the landfill, and this whole issue is now remediated and is contained.
Okay.
One other issue with Waste Connections, I think, is that the worry that higher fuel prices will end up impacting their business today. But again, historically, they've been very disciplined, and their focus on smaller and vertically integrated markets allows them to manage that.
Okay. Ernest, got to leave it there. Thank you for coming in. Good to see you.
Thank you.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.